morning, everybody. As Richard said, my task is to briefly set the scene and provide some context for discussion by the expert panel which is to follow. So in that context, what I want to do is just really offer some comments and observations on three things: the economic background and context for the Nordic real estate markets. Secondly, to look at real estate investment in the Nordic markets and pick out some key market traits and some trends, and then offer a view on some aspects of the outlook. So if we start with the economy, I think the main theme come through my comments on this is the relatively favourable and positive picture that emerges with regard to Nordic economies and certainly their recent economic performance. So this chart is showing you the trends in real GDP, all indexed to the start of 2008, just on the eve of the crisis and then deep recession which hit the global economy, and then through the recovery period through to the end of last year. And the dotted line there is showing you the performance of the Eurozone, which we're using as a sort of reference point here. And I just pick out a few key trends in the market. Clearly, Norway suffered a relatively mild downturn compared to most other Western European economies, and currently it's seen a recovery and its GDP is above where it was pre-crisis. Sweden suffered rather more of a contraction in GDP in the crisis, but you will see there a very strong rebound, and this, in fact, this performance has been one of the best of any European economy. Slight touch of weakness there at the end of last year, maybe its exports beginning to be cooled a little by the wider slowdown. Finland suffered a much worse contraction. It's rather more narrowly based economy, phones and forestry, people often say, but equally a very strong rebound, you'll see, from that low point coming back, certainly in terms of the growth rate, again, that it's achieved over the past 2 to 3 years, very good. And a slightly weaker outcome you will see for Denmark, and that does pick up a theme where if we had to pick one among the four, which tends to be the somewhat weaker partner, it is Denmark. Now, the other very, very distinctive feature of the Nordic economies taken in a European context at the moment is their degree of what I will call fiscal rectitude relative to the general picture which we see across Western Europe, and which we see, in fact, across much of the developed world, because the USA and Japan and others are serious offenders, if you like, in terms of scale of public sector deficits and certainly the percentage of debt to GDP. So on this slightly complicated chart, the diamonds, which are on the scale on the right-hand side, are showing the percentage of government debt relative to GDP. So Greece, there you can see, has a ratio of about 160% and is running a current deficit of spending in excess of revenue of getting on for 10%. So that is probably the worst situation you can see on this chart. But if you look over to the right-hand side there, then you see, shown in the lighter green, the Nordic economies with much, much lower government debt relative to GDP. In general, they're in the sort of 40 to 60% range. Much smaller deficits, and in the case of Norway, actually showing a surplus of revenue in excess of spending. You can't see Sweden there because that's actually almost zero, effectively, is imbalance, zero deficit. So a very strong picture emerges for the Nordic economies in terms of their public sector finances relative to elsewhere in Europe. And in turn, as one might expect, then perhaps those economies, or their governments in particular, have been rewarded by the bond markets by the fact that their government bonds, the spread over the German Bund, if we take that as the AAA gold-plated, has remained pretty tight if you look at the scale on that map. And indeed, Sweden has had periods where its, over the recent past, where its government bonds have been at yields lower than, as they are at the moment, well, not quite, have been recently, the German Bund. And in turn, their very solid performance has been reflected in the strength of the currencies. And again, the distinctive feature here, of course, is that 3 of the 4 economies we're considering here are outside the euro. And the trend, certainly in the Swedish and Norwegian currencies against the euro, certainly if we go back to the situation as was in the depth of the downturn in 2009, you can see there how the currency has strengthened very sharply against the euro. So there's 2 points here in a sense, to some degree, being outside the euro is presently a positive, but it is coming with strength in the exchange rate, which is not always a great advantage. Turning to investment market trends, then this shows the overall picture in terms of quarterly and annual running turnover in European investment markets, just to sort of provide the context. So from the low point in 2009, hit at the beginning of 2009, we've seen investment volumes stage a recovery and come back. Last year, over the year as a whole, we were 7% up on the year before, which in turn was a big increase on 2009. But we are not anywhere near, as you can see, getting back to the volumes of 2006, 2007, which may, in the fullness of time, be seen as very much an aberration and unusual. Now, within that picture, there has been sharp contrasts in the European markets in terms of the proportionate recovery in investment turnover. And here I'm just taking last year, the volumes change in percentage terms against 2010 in a number of different regions and countries across Europe. And the extremes of this are in Central and Eastern Europe, CEE there, you saw an almost doubling in the volume of investment in 2011 compared to 2010. And over on the right-hand side, in Iberia, Spain and Portugal, investment volumes were 40% down on 2010. So we've got really rather contrasting experiences here. And interestingly, the Nordics sit slap bang in the middle of that there, where investment was slightly up in volume terms on the year before. In fact, that followed 2010, where you'd had a very big proportionate increase in that year in the volume of investment in the Nordic markets compared to the low point of 2009, which indeed was, as you can see here, a very low point in the Nordic markets. I mean, they fell in volume terms from a peak in 2006 of over 30 billion euros down to about, whatever that was, 7 or 8 billion euros in 2009. It really was a precipitous slump in volume terms. So they have rebounded somewhat, quite positively relative to Europe as a whole, you can see, and the share of the Nordic markets in the total European market has picked up over the past 2 years, and now running in both those years at about 14% of the total, which actually, in terms of the relative size of the Nordic economies, one might say, in the totality of the European economy, or their levels of activity in occupational markets, is a more than proportionate share for the Nordics of the European investment market. And so they're ticking along now at a level which is broadly in line with the average of the last few years. Clearly shown here that Sweden is the largest market, followed, as one would expect in most years, by Norway, but with Finland kicking in some years, showing a strong level of activity. If we look at the 10 most active European investment markets in 2011, the first 2 places not surprisingly taken by the usual suspects of London and Paris, but it's notable that the Nordics managed 2 entries in 2011, Stockholm, which came in at number 3, and Oslo, which managed to get in at number 10. The others, probably as you would expect, again, the representation of German cities. Manchester was in there on the back of one large shopping centre deal. Now, one of the other features worth noting of the Nordic markets in terms of their investment trends, if you like, is the proportion of cross-border activity relative to total activity in the market. And the point that I want to make here is that relative to activity in European markets as a whole, differentiating between local and cross-border, the Nordic markets see proportionately less cross-border activity and more locally based investment. And that's shown here in the percentages, if you like. In fact, if we look at the breakdown year by year of local versus cross-border, and we've split here then the cross-border activity between that which is capital coming into the Nordic markets from elsewhere from investment within the Nordic region by, let's say, Swedish investors into Norway or Danish investors into Finland, the sort of intra-Nordic, then you see actually that intra-Nordic investment, cross-border intra-Nordic investment, is a significant proportion of the total cross-border investment. And the Nordics as a whole have gone from a situation where pre-crisis, back in the 06-07 period, around 40% of total activity was cross-border. That slumped, obviously, as the market contracted to a very low share in 2009, and now it's come back to around about 25%, with a rather more even balance between cross-regional and intra-Nordic. Where does the cross-regional investment coming into the Nordic markets originate? This shows the picture for 2010-11, when 8% of the total investment in the Nordic markets came from the world outside Nordics. The bulk of that clearly coming from the rest of Europe. Small amounts from North America and from the Middle East, and indeed from as far away as Australia. On our records, no involvement by Asian investors in the Nordic markets. So that is the picture. Most of the investment into the Nordics, therefore, coming from relatively close to home. Another feature of the Nordic markets that is worth noting is the difference that we see between the sector breakdown of investment in these markets by Nordic investors, both local and intra-Nordic, and the longer-range cross-regional investors. You'll see that the Nordic investors, over the period since 2005, actually have quite a diverse spread by sector, with offices taking the largest share, about 42%. That would be in line with the European average, but actually quite a low share for retail at 13%. That would be well below the European average, and a significant proportion there, 17%, in the residential market, and then various other categories. But in the cross-regional category, in terms of investors coming into the Nordics from elsewhere, a very different pattern, and in particular, this very strong bias towards retail sector investment from longer term. And I think that is an interesting point and feature of the market that may well be worth picking up in the panel discussion as to why that is the case. Now, the economic strength and recovery trends in the Nordic markets has fed through to the performance of their property markets in terms of returns to investors. This chart is based on our own European valuation monitor, which is based on data from valuations of client portfolios, which we undertake across Europe. And we're comparing there the Nordics against a number of other countries or regions in Europe. Not surprisingly, you see there the weakest trends being recorded by Southern Europe and Ireland, and indeed the strongest trends, certainly in terms of the depth of the downturn, the loss of capital value in the downturn, the Nordics escaped more likely than other markets and have seen a recovery since, although in line with a number of other markets across Europe, some signs possibly of a little weakness in terms of average values, not necessarily prime, but average portfolio valuations coming through at the end of last year. Looking at the prime market, we, for a range of cities here, are showing the position with regard to current prime office yields relative to where they were at the cyclical low, the peak of the market, if you like, and where they went to at the cyclical high. Maybe a little difficult to pick out all of the Nordic centres here, but in the main, the picture that comes through for Stockholm, for Oslo, and Copenhagen, which is actually a strong one, is that there has been a significant repricing from the cyclical high, the low point of the market, and these prime yields are now nearer to their cyclical low in general in these markets than their cyclical high. In the case of Copenhagen, we've got all the way back to, it would seem, where we were at the peak of the market. Now, that in turn has fed through into the proportionate recovery in capital values. So based on our records of prime rents and yields in leading office markets across Europe, we can compute what the fall in prime capital values from peak to trough was and what the recovery has been so far from the trough of the market to the end of last year. You'll note there that certain of the Nordic markets, notably Oslo in third place there, a little further across Stockholm and Helsinki. Copenhagen is more in the middle, but have all shown positive, quite significant positive recoveries in prime office capital values from the trough, having been variously hit quite hard in the downturn, but they have shown a significant rebound, in marked contrast to a set of markets over on the right-hand side there where you've seen no rebound at all. And the same sort of picture emerges if we look at prime shopping centre yields by national market. Now, the level of yield presently in the Nordic markets, which are clustered there, sort of just to the right of the UK, Sweden, Finland, and Denmark are there. In particular, you can see very much in terms of relative pricing, the Nordic markets are, if you like, towards the lower yielding markets, the pricier prime markets in Europe. Now, just a quick comment on the outlook. Everybody knows, I'm sure, that this year is expected across Europe to be a difficult year in economic terms, with the hope that next year may be somewhat better. In that context, if we look at expected growth this year, forecast growth next year, the Nordic economies come out in a relatively favourable position, certainly looking best for Norway across both years. Weak growth this year for Sweden, for Finland and Denmark, but the expectation of some improvement next year. Again, a sharply contrasting picture with that for the economies over on the right-hand side of that graph, or indeed against a much better picture compared to the Eurozone as a whole. And if we look further into the medium term, using Oxford economic forecasts here, and again, the expectations here for growth in GDP through to 2014-15 in the Nordic economies in the main look pretty solid, and again, look good relative to the Eurozone. And to take a particular aspect of the economy in terms of consumption growth, private consumer spending here, where on this chart we're looking at the short-term trends, growth over 2011-12 on the bottom axis, and then on the vertical axis, the medium term, 2013-14. You see that certainly three of the Nordic economies come out in a strong position relative to other European markets, both in the short and in the medium term. So a pretty positive outlook on these forecasts, to be fair, pretty positive outlook for the consumer economy in these markets. And worth bearing in mind in that context, in terms of the supply side, while they vary, Norway seems to have a relatively high shopping centre stock relative to its population. But Sweden, for example, is over there on the left-hand side between the Netherlands and Italy, looking much less fully supplied, if you like, with shopping centre space than some of the other markets on that track. Certainly less than, for example, the UK, which is further over to the right next to Finland. We again carried out this year our survey of European investor intentions in February, and I'm just taking one question here from the survey which asked which is the most attractive country or region in Europe for investment purchases in 2012. We had over 340 investors responding to this survey, similar to the number we had last year, and this shows the picture. Now, the main change from last year is actually the recovery in the popularity of the UK and some reduction in the attraction of Germany and Central and Eastern Europe, which were the other most attractive regions. But we do see in this survey that while in terms of being the most attractive, the Nordics are a relative minority interest in the market as a whole, nonetheless, they did attract a higher share this year of interest. If we pin it down to which city in Europe is the most attractive, which is a rather more pinpoint thing, then London wins still head and shoulders over anywhere else in Europe. But looking down the list, it is worth noting that Stockholm did manage to get into the top 10 in terms of preferences. So just to wrap that up and draw out a few themes, which I hope perhaps might find some coat pegs on which to hang the discussion. The Nordics are distinguished by a relatively positive economic context, particularly in a European setting. We've seen a strong recovery, for example, from the crisis in Sweden and Finland. Norway, helped, of course, by its oil resources, relatively minor downturn. And if we look into the medium term, the forecasts are suggesting relatively favourable outlook, particularly on the consumer side. They are distinguished, as I said, by their fiscal rectitude. At the moment, their position outside, in three out of four cases, of the Eurozone and all its travails and instabilities and uncertainties, might also be regarded as an advantage. Relative to their size, these are active and liquid investment markets, although local and intra-Nordic investors dominate in these markets. The proportion of cross-region activity is relatively low, and it is notably biased to retail. And if we look in the market at the pricing recovery that has taken place in these markets since the bottom of the downturn, then we see, and I think we saw, that it has been among the strongest, certainly at the prime property end of the spectrum, among the strongest in Europe.